Hi, welcome back to Money Talks with Mia. I'm Mia Lee, escort, stripper, CPA, and recovered banker. Every week, we're going to talk about a new topic that will steer you toward financial independence and wealth building. Today's topic is credit. Credit is another word for financial trustworthiness. Your credit score is a numerical determination of how likely you are to repay a lender and also how safe a financial institution considers it to lend to you. Why do we care about credit? Well, you're probably one day going to want to buy a house, buy a car, have a mortgage, have a car loan, maybe start a business, have a line of credit for that business, or take out a private student loan. All of these things are dependent on having good credit. Not only does your credit score determine what interest rate and repayment terms a bank lends to you at, it will also determine whether or not a financial institution will lend to you at all. If you have really poor credit, you might not be able to get a mortgage or a line of credit to open a business or buy a house. I've even heard of prospective employers checking your credit score as part of a background check because having poor credit is considered a risk factor that makes potential employees less reliable and more likely to commit fraud and steal. Now that we know how important credit is, let's talk about the basics of credit scores. So there are three major credit reporting agencies: Equifax, TransUnion, and Experian. And these three agencies report what is called a FICO score. It was an acronym for Fair Isaac and Company, after the company's founders, two long dead white guys. We don't really care about them. But what's important, FICO scores are still used today to determine your creditworthiness. FICO scores are reported on a scale from 300 to 850, 300 being the worst, 850 being the best. Here's a pie chart of the factors impacting your credit score and the weight of each factor. The most important one is going to be a history of timely payments, or your payment history. This is 35% of your score. The next most important thing is going to be your credit utilization, which is how much of the available credit that you have are you using. You ideally want to keep this number under 10%. If 10% is not possible, you want to keep it under 30%. The next factor impacting your credit score, which is 15% of your score, is the length of your credit history. That means both the total length of your credit history, like when did you first receive credit ever in your life, and also the average age of your credits. How old is the average age of each line of credit, each loan, each credit card that you have? Finally, the last two factors that make up about 10% each of your score are the number of hard inquiries on your credit report and the credit that you have. And you're not going to have a whole lot of control over these two, but we'll talk about them anyways. Let's talk about your payment history and how to build and improve upon that. If you have a delinquency in payment of 60 days or more, that gets reported to the credit reporting agencies. That is going to have a substantial negative impact on your credit score. The later it is, meaning if that payment is 90 days late, that's worse than if it's 60 days late. And if the payment is 2 years late, that's worse than if it's 6 months late. The later and more recent that late payment is, the worse the impact on your score. If you've missed a payment and subsequently made that payment, that late payment stays on your credit report for about 2 years. After 2 years, it'll fall off. If you've declared bankruptcy, that completely ruins your credit for 7 years. The next factor impacting your credit score is your credit utilization. This is about 30% of your score. Credit utilization basically means how much credit do you have and how much of that are you using. Ideally, you want to keep this number under 10%. If possible, and if not, under 30%. To put a tangible example to this, I have about 12 credit cards. On those credit cards, I have a total outstanding credit available to me of about $400,000. Now, I don't spend anywhere near $400,000, but the reason I like having so much available credit is because it's easy for me to keep my credit utilization under 10%. Let's say I have a very expensive month, or maybe I'm paying for things for other people, and I run up $20,000. That's still under 10% of my total available credit, and it keeps my credit utilization under 10%. That's why I care so much about having a lot of credit and I keep old cards open, is because I want to have a low credit utilization percentage because it's 30% of my credit score. Next most important thing impacting your credit is the length of your credit history. That is both the total length of your credit history as well as the average age of any type of credit that you have. Let's say you have two credit cards and one is 4 years old and one is 2 years old. Your total length of credit history is going to be 4 years. Your average age of credit is going to be 3 years because it's 4 and 2 and the middle is 3. Finally, types of credit is something that we don't really have a lot of control over, but it's just something to be aware of. Credit cards are one type of credit. Mortgages are another type of credit. Installment loans, like if you finance a mattress or take out a car loan, that's another type of credit. The idea is you are considered more creditworthy, meaning you'll have a higher credit score if different types of lenders are more willing to lend to you, and therefore you have different types of credit. Obviously, you're not going to buy a car just to increase 10% of your credit score, so you can't really manufacture diversity of types of credit, but it's just something to be aware of. Let's talk about a few tips and tricks to build your credit if you don't already have credit, and ways to increase your credit if you already have credit. When I was 18, I obviously started off without having any credit. I opened what's called a secured credit card. I went to the bank and I put down $1,000 to borrow against. And you might ask, why the hell would you give the bank money to borrow against your own money? And the answer is to build my credit faster. If you have no credit history at all, you're gonna get introductory credit card offers that are gonna be really crappy in terms of having little to no rewards, but more importantly, they're gonna give you very low limits. If you have no credit at all, you're gonna be offered credit cards with like a $500 limit. And the reason why that's not helpful is because you're going to be maxing out that number right away. You could make one purchase and it would be like $450 and you've immediately maxed out your credit card. That's not really great for your credit because it drives up your credit utilization. So it's going to take you longer as a new person to build credit than if you have a higher credit limit to start off with, and you can get a higher credit limit by opening a secured credit card. Let's say you've opened a secured credit card and you've had it for about a year. You probably don't need that anymore because you're going to receive offers probably within 6 months, maybe a year, assuming you're making on-time payments, that are much better than what you were initially being offered as somebody with no credit history. Once you open your first unsecured credit card with a reasonable limit that you can stay under a 30% utilization on, you can get rid of your secured card, meaning you can close it and take your money from the bank and go invest that money somewhere else. Once you have unsecured credit cards, meaning normal credit cards that you don't have to put money against, you want to keep the oldest one open for as long as possible. And the reason you want to do that is because you want to drive up the average age of your credit and the total length of your credit history, because that's another factor impacting your score. It might seem counterintuitive to keep open old credit cards that you're not using, but I'll tell you that I do it because I want to increase my credit score by having a longer average length of credit history as well as a longer total credit history length. Another thing that you can do once you have established credit is ask your credit card companies every year or so to raise your credit card limits. Again, this might seem counterintuitive to have all this credit that you don't need, but in order to keep your credit utilization low, it is very helpful to have higher credit limits. I do this every year, actually. I ask my bank to increase all of my credit limits. And they typically say yes, because I keep making more money. And they're just like, why not? We'll give you more credit. Let's hope that you don't pay it off right away. And you pay interest on it. Now I never do because I pay off all my credit cards right away, and I never pay interest on my cards, and I never pay late fees, but they are kind of banking on it, so they give you more credit. The last thing I want to talk about that you have some control over is the number of hard inquiries to your credit. 10% of your score is the number of hard inquiries on your credit report. A hard inquiry happens when a financial institution checks your credit in order to determine if you are worthy to lend to and what those terms of that loan will be. That can happen when you open a credit card, lease an apartment, or buy a car if you want a car loan, or when you apply for a mortgage. Every time you get one of these hard hits, it goes on your credit report. And the idea is that you don't want to have too many of these. You want to have less than 2 hard inquiries on your credit every single year in order to have the highest possible credit scores. You might have a year where you buy a car, buy a house, and open a credit card in the same year. Of course, you're going to have more than 2 inquiries. And you don't want to let this stop you from living your life, but it's something to be aware of so that you don't open 15 credit cards in a year. That's going to be 15 hard inquiries. That's not going to be very helpful for your credit score. Finally, with respect to diversifying your types of credit, this isn't something that you're going to have a whole lot of control over because you're not going to buy a car just to have a car loan so that you can improve your credit by 10%. And you can't take a mortgage out against a house that you don't own. Many of us are only going to have credit cards as our only form of credit, but student loans are another form of credit. Installment loans are another form of credit. One of my friends financed a mattress, and that's a different type of credit than her credit card. I had an option for the management company that manages my building where I was able to report my rent payments to my credit reporting agency. So that counted as a different type of credit than my credit card. So that was a way to diversify my types of credit without a mortgage or a car loan. Credit diversification is 10% of your score. You don't have a whole lot of control over it. It's something to be aware of, but not something you can do a whole lot about. The last thing I want to talk about is you want to be running your credit report every year. All these things that we talked about that comprise your credit score are on your credit report. So it's something that you want to run every year, and you can do it for free. The FTC has a link on their website to annualcreditreport.com. It's a website that will provide you your free credit report once a year from all 3 credit reporting agencies, Experian, TransUnion, and Equifax. Your credit report shows the entire history of you as a lendee. It will show you your entire history of payments, the length of your credit history, your average credit age. It will show you all the types of credit you have ever had. It will also show you potential mistakes that you might not be aware of. So if somebody stole your identity and opened a credit card and never made a payment on that card, you'll see that on your credit report. If you see payments that are marked as delinquent that you actually made on time, that's a mistake. Another reason you want to run your credit report is because you want to correct any of those mistakes, such as stolen identity, someone else's activity, or late payments that you actually made on time. You could do that through the same website, annualcreditreport.com. You can submit a dispute to each of the credit bureaus, and you can have the incorrect activity removed from your credit report, which will be very important to having the best possible credit score. That's all I've got for you on credit. Thank you for bearing with me through a boring topic. I'm Mia Lee. You can take the girl off Wall Street, but you can't take the banker out of the whore. Please leave me your comments, questions, and suggestions for future episodes.